Co-founder of Microsoft, Bill Gates is one of the greatest entrepreneurs of our time and is also now the 6th richest person in the entire world. Through the Bill and Melinda Gates Foundation Trust, Bill Gates has invested nearly $39 billion into 74 different common stocks. But here's the crazy part, the top 7 stocks in his portfolio make up over 92% of his entire portfolio value. Out of these 7 stocks, 6 of them are dividend-paying stocks. So in this video, we'll be looking at the top 6 dividend-paying stocks that Bill Gates owns through his foundation's trust. To analyze these stocks, we'll be using my stock valuation spreadsheets, which you can download on my Patreon page at the link in the description. The first and largest holding in Bill Gates' portfolio should come as no surprise to anyone, and that is Microsoft. Its current share price is around $374 a share, and it makes up 31.88% of his entire portfolio, with him owning over 39 million shares, giving it a total value of over $14.7 billion, and they pay out over $117 million in annual dividends. We can see Microsoft over the past year is up around 51%, and year to date up over 56%, so it's performed extremely well during this time period. If we look at the starting dividend yield from Microsoft, we can see it is pretty low, below 1%, sitting at 0.8%, but the real magic with Microsoft's dividend payments isn't about the yield, it's about the dividend history and the dividend growth. If we jump over to the dividend history tab here and look at the past 10 years, we can see a steady history of increasing those dividend payments over time. 10 years ago, they were paying out around 23 cents per share quarterly. Jump forward to now, it is now sitting at 75 cents per share every single quarter. So when we look at those dividend growth rates, I'll scroll down, you can see the 3-year over 10%, the 5-year dividend growth rate over 10%, and the 10-year dividend growth rate over 11%. So a really good history of dividend growth. Now, obviously, all this means nothing if those dividend payments aren't safe. So if we jump over the dividend safety tab, we'll scroll down and look at the cash flow payout ratio. The cash flow payout ratio is my favorite payout ratio because dividends are paid out of free cash flow. And this is basically telling us 20% of Microsoft's free cash flow is being used to pay out dividends. That's a very healthy range, and it's a range that's going to allow them to continue to increase those dividend payments every single year. And speaking of cash flow, one of the most important metrics is free cash flow per share. This is something I always look at when analyzing a company. So if we jump over to the statement of cash flows, we can come down here and we can see our free cash flow per share over the past decade. And if we look at it charted out for Microsoft, we can see they've seen really nice free cash flow per share over the past decade. Now, why is this metric important? Well, you have to remember there are 5 different ways that a company can reward their shareholders with free cash flow. Like we already saw, they can pay out dividends, they can also reinvest back into the business, they can perform share buybacks, pay down debt, and they can also attempt mergers and acquisitions. So if we jump over to the balance sheet for Microsoft, we can see some of these other ways that they have been rewarding shareholders. If we scroll down to long-term liabilities, we can see right here long-term debt. It looks like since June of 2017, they've done a really good job of paying down this long-term debt, putting them in a very healthy cash position. But if we scroll down, what's even more impressive to me is if we look right here, total common shares outstanding. If we look at this charted out, we can see over the past decade, they've done a really good job of performing share buybacks, which is reducing the total amount of shares outstanding, which is a phenomenal way for shareholders to be rewarded. Now, if we jump over to my stock valuation spreadsheet again, you can download this on my Patreon page at the link in the description and join a community of dividend investors. But if we come up here and plug in stock ticker MSFT and hit enter, you can see all this data will automatically load in. We've already touched on the dividend data, but we can see analysts have a target price of around $415.23, a beta of 0.9, so you should see a little less volatility than that of the market. Now, the 2 valuations we'll focus on with Microsoft are the discounted cash flow and the dividend discount model. If we look at the DCF model first, I'll go ahead and zoom in, and basically what we're doing is projecting how much free cash flow Microsoft will produce in the future. And based on analyst projections, historical projections, and industry standards, I'm projecting a growth rate of around 15.5% for the future free cash flows of Microsoft. After finding the present value of these future free cash flows, I added them together, added the company's cash and cash equivalents, and subtracted out the total debt. Now, one of the things you'll notice is cash and cash equivalents quite a bit higher than total debt, which is a phenomenal thing to see from a company. But after I've done that, we get the equity value, divide by shares outstanding, and you can see we come to a discounted cash flow price per share of around $327. Now let's look at the dividend discount model. The idea behind this valuation is we should be able to value a company based on how much they pay out in dividends and how much those dividend payments are increasing over time. So I plugged in those quarterly dividends over the past 2 years so we can see the yearly dividends, and it looks like they have been increasing it at around 10% every year. Now moving forward, I'm projecting a growth rate of 8.25%, discount rate of 9%, and that gives us a dividend discount model price per share of $433. So again, Microsoft by far the largest position in Bill's portfolio. The second position in Bill Gates' portfolio is the only position out of his top 7 that does not pay a dividend, and that is Berkshire Hathaway. We can see he has a total value of about $8 billion in Berkshire, and it makes up around 20.28% of his entire portfolio. Obviously, Bill Gates has a very good relationship with Warren Buffett, so it's no surprise that he is invested in Berkshire Hathaway. We can see he has seen good returns over the past decade, up around 213%, and over the past 5 years, up around 78.85%. But let's go ahead and look at the next dividend stock that he owns. The third largest holding in Bill Gates' portfolio is an interesting one. We have stock ticker CNI, which stands for Canadian National Railway, and it makes up over 15% of his entire portfolio. He owns over 54 million shares, which is a total value of around $6.5 billion, and they pay him over $127 million in annual dividends. If we jump over to Seeking Alpha, we can see over the past year they're down around 5.7%, but year to date we can see they're slightly up around 0.66%. Now the starting dividend yield a little bit higher than Microsoft. We're seeing it's sitting at around 1.95% at its current prices. This company also has a pretty decent history of dividend growth. We can see there was a quarter in 2020 where they did not pay out their dividends, but for the most part, pretty solid dividend growth over the past decade. They went from paying around 21 cents per share all the way up to around 58 cents per share. So if we jump over to the dividend growth tab here on Seeking Alpha, we can see the 3-year dividend growth rate sitting pretty high at around 21%. Keep in mind, it's partially high because there was one quarter in 2020 they didn't pay a dividend, but even the 5 and the 10-year dividend growth rates both really high at around 11%. So we're seeing a little bit of trend with the dividend growth rates being high with stocks that Bill Gates owns. Now, if we look at the dividend safety, we can see the cash flow payout ratio for trailing 12 months and forward looking, both sitting at around 30%. Again, that is a very healthy range. So if we go ahead and jump over to my stock valuation spreadsheet, we'll come up here, we'll plug in the stock ticker and hit enter. And again, this data will automatically load in. Again, current trading price around $119.96, and analysts have a target price of around $121. A beta of 0.7, so that means that the volatility with this company should be very low. Now, the first valuation we'll use for Canadian National Railway is going to be the discounted cash flow analysis again. We put it through the exact same method, except this time we're going with a growth rate of 10%, and we had to adjust some of these variables. But essentially, we come to a discounted cash flow price per share of around $104 a share. Now, this time we're actually also going to look at a multiples valuation. We didn't use this with Microsoft for a few reasons I haven't mentioned, but I can touch on that in another video. But essentially, the idea behind the multiples valuation is we should be able to see what the fair value of a company is based on how the market is valuing companies that are similar in structure. So you can see our comparable companies right here. Basically, what we're doing is we're taking their stock price, dividing by the earnings per share to get the price to earnings multiple. We take the average price to earnings multiple and multiply it by CNI's earnings per share, and we come to an intrinsic value of around $118.11, which again is very close to that current trading price as we just saw. The last valuation we'll use is again the dividend discount model. So again, we're seeing what this company is valued based off how much they pay out in dividends and how much that dividend is increasing. And this time I went with a growth rate of 6.5% after analyzing these dividends. That gives us a dividend discount model price per share of around $123.75. So for the most part, it looks like this company is pretty close to fair value. The fourth largest holding in Bill Gates' portfolio is Waste Management, stock ticker WM, and it makes up around 13.8% of his entire portfolio, and he owns over 35 million total shares, which gives it a value of around $6.3 billion, and it pays out over $98 million in annual dividends. Waste Management has seen a pretty decent year over the past year. They're up around 7.38%, and year to date up around 14.03%. If we look at the starting dividend yield, again, not super high, sitting at around 1.59%, but this is another example of a company that has a good history of dividend growth. If we look 10 years ago, we can see they were paying out around 37 cents per share, and jump forward to now, around 70 cents per share. If we look at these dividend growth rates, I'll scroll down, we can see the 3-year at 8.7%, 5-year a little bit lower at around 3.37%, but the 10-year pretty decent at around 6.73%. If we look at that dividend safety tab, the cash flow payout ratios for the trailing 12 months and forward looking, both around 25%. So that trend of low cash flow payout ratios and nice dividend growth rates continues for Bill Gates' holdings. If we jump over to my valuation spreadsheet, we'll go ahead and come up here and plug in WM and hit enter, and we can see current trading price around $179, and analysts have a target price of around $182. The beta is sitting at 0.7, so again, another example of a company that you should expect low levels of volatility from. If we jump over to our discounted cash flow analysis, we'll go ahead and zoom in, and once we plugged in all of our variables, you can see we have a free cash flow growth rate of 14%, we come to a DCF price per share of around $160. With the multiples valuation, you can see our comparable companies right here, very similar in structure to Waste Management, but they have an average price to earnings of around 34.18. So when you apply Waste Management's earnings per share of 5.66 to this formula, we come to an intrinsic value of $193.48. And the last valuation will use the dividend discount model. Again, keep in mind, they just announced a 7.1% dividend hike with this company, and we can see on my dividend discount model, I'm projecting a 7% dividend growth rate moving forward. That gives us a dividend discount model price per share of around $199.73. So when we jump over to the output tab, we come to an intrinsic value of around $184.35. So it looks like it may be slightly undervalued as of right now. The fifth largest holding in Bill Gates' portfolio is Caterpillar, stock ticker CAT. It makes up around 5.16% of his entire portfolio, and he owns over 7.3 million shares, gives it a total value of close to around $2 billion. It pays out total dividends of over $38 million. And for Caterpillar, over the past year, they've done pretty well, up around 13.79%, and year to date, up around 9.44%. Now, the starting dividend yield for this company is sitting right at 2%. Let's go ahead and see if the trend of dividend history continues. If we scroll down again, you can see a nice history of dividend growth. 10 years ago, paying out around 52 cents per share, and jump forward to now, $1.30 per share every single quarter. If we look at the dividend growth rates for Caterpillar, we can see pretty solid growth rates over the past 3 years, around 6.67%, and for the 5 and 10 year, both around 8.5%. Look at that dividend safety tab. We'll scroll down again. Cash flow payout ratio for trailing 12 months and forward looking, both sitting right at around 25%. Another example of a very healthy cash flow payout ratio. If we jump over to the valuation spreadsheet, we'll go ahead and come up here and plug in CAT and hit enter. The data will load in, and we can see analysts have a target price of around $265 per share, right at that current trading price. Now, the beta for this company is actually a little above 1. Now, that means the volatility will be a little bit more than that of the market. And for Caterpillar, I do think it makes sense to use Graham's valuation. This is a valuation we haven't used yet, and it was designed by Benjamin Graham in order to calculate intrinsic value using earnings per share growth. And here's the formula he lays out for us. Basically, we're looking at the earnings per share of a company like Caterpillar. We're applying our growth rate projection and multiplying it by 4.4, which is the average yield of AAA corporate bonds. We then divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's sitting at 4.91. This gives us an intrinsic value for Caterpillar sitting at $312.45, a decent bit above that current trading price. Now, the next valuation we'll use is one we've looked at a little bit already, and that is the discounted cash flow analysis. And again, after plugging in all of our variables, you can see we come to a DCF price per share of around $254.50. The next valuation we'll use is the multiples valuation. You can see our comparable companies here have an average price to earnings of around 12.43. Using Caterpillar's earnings per share, we come to an intrinsic value of around $219. The last valuation we'll use, the dividend discount model. Again, you can see I'm assuming a growth rate of around 6.75% for those dividend payments, discount rate of 9%, and that gives us a dividend discount model price per share of $246.71. So when we jump over to the output tab, with all four of these valuations averaged together, we come to an intrinsic value of around $258.27, pretty close to that current trading price. The sixth largest position in Bill Gates' portfolio is Deere and Company, stock ticker DE, and it makes up around 3.8% of his entire portfolio. He owns around 3.9 million shares, which comes out to around $1.5 billion in total value. Now, the total dividends that it pays out annually is sitting at around $23 million. If we jump over to Seeking Alpha, we can see DE is actually down around 17.7% over the past year, and year to date down around 15.3%. The company's starting dividend yield is sitting at around 1.64%, and if we jump over to the dividend history tab, we can see another really nice example of solid dividend growth over the past decade, going from around 51 cents per share quarterly all the way up to around $1.47 per share quarterly. And we can see as of recent, those dividend payments have really started to increase at a pretty rapid rate. So if we jump over to the dividend growth tab, we can see the 3-year dividend growth rate sitting at an extremely high 18.43%. That's absolutely phenomenal. We can see the 5-year really good at 14.38% as well, and the 10-year dividend growth rate sitting at around 9.76%. If we look at the dividend safety and look at that cash flow payout ratio for the trailing 12 months, only sitting at 8.85%, and the forward-looking cash flow payout ratio sitting around 17.7%. So that leaves plenty of cash flow left over for this company to do things like reinvest back into the business, pay down debt, or perform share buybacks. Now, if we jump over to my valuation spreadsheet, we'll go ahead and come up here and plug in stock ticker DE and hit enter. And again, the data will load in. Analysts have a target price of around $427 per share, and the beta is sitting very close to 1, so the volatility should follow the market pretty closely. We'll use all 4 valuations in this scenario, and we can see with Graham's valuation, I'll go ahead and zoom in a little bit more. After plugging in all of these variables, we come to an intrinsic value of around $329 per share. With our discounted cash flow analysis model, though, we come to a lower valuation of around $270. With our multiples valuation, we actually come to a very high valuation compared to the trading price, sitting at around $480 per share. And lastly, that dividend discount model. Again, a fairly high valuation compared to the current trading price. Again, we've seen really good dividend growth from this company over the past few years. We've seen 38%, 14%, and 22.5%. So on the output tab, if we look at all 4 of these valuations, we come to an intrinsic value of around $375 per share, right at that current trading price. The final dividend stock we're going to be looking at in Bill's portfolio is stock ticker ECL, Ecolab, and it makes up around 2.27% of his entire portfolio, with him owning over 5.2 million shares. This gives it a total value of a little over $1 billion, and it pays him almost $12 million in annual dividends. Now, this company operates within the materials sector, and we can see it's trading at around $198.50 per share, and over the past year, it's performed very well, up around 27%, and year to date, up around 34.84%. Now, this is another low-yielding dividend stock for Bill, sitting at around 1.18%. But we do have good news coming from this company very recently. We can see they increased their quarterly dividends by about 8%, so that's a pretty nice dividend hike overall. Let's go ahead and look at that dividend history. I'll scroll down and we can see over the past decade, again, another good example of a company with nice dividend growth, going from 23 cents per share all the way up to now 57 cents per share. If we look at these dividend growth rates, we can see the 3-year sitting at around 4%, the 5-year sitting at around 5.27%, and the 10-year around 8.71%. And if we look at the dividend safety again, all of these companies have nice cash flow payout ratios, sitting around 25% forward looking, and for the trailing 12 months, around 28%. So it's very clear Bill is looking for companies with low cash flow payout ratios and nice history of dividend growth. If we jump over to our valuation, we'll go ahead and plug in ECL and hit enter. We can see analysts have a target price of around $196 per share, very close to that current trading price, and the beta sitting a little above 1, so you'll see a little more volatility with this company. Now, we're only going to look at 2 valuations in this scenario. We'll look at the multiples, so I'll go ahead and zoom in, and you can see our comparable companies here. Again, the average PE for these companies sitting at around 32.57. So when you multiply that by ECL's earnings per share of 4.3, we come to an intrinsic value of $140.09. With the dividend discount model, assuming a growth rate of 7.25% and discount rate of 8.5%, we come to a dividend discount model price per share of $195.62, very close to that current trading price, and it's actually also very close to what we saw for analysts' target price at $196.48. So after looking at these 6 dividend-paying companies in Bill Gates' portfolio, one thing is very clear. He doesn't just have a love for dividend stocks, but a love for dividend growth stocks. Stocks that have the ability to continue to increase the amount they pay out in dividends every single year. This is the exact same strategy that I'm utilizing with my personal dividend portfolio in hopes that it will help me one day live off of dividend income. If you enjoyed the video and also want to keep up with my living off dividends journey, then be sure to subscribe to the channel. And like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.